Welcome back to the Deep Dive. We are here to give you the ultimate shortcut to being well-informed, tackling dense subjects, pulling the surprising facts from the source material, and ensuring you walk away with real, actionable knowledge.
Today, we are diving deep into, well, what I would call the financial bedrock of every business, every project, every single investment decision you might ever encounter. We're talking about cash flow.
Right. And our mission today is to move far beyond just a simple definition. We want to show you why cash flow analysis is, I think, the single most powerful tool for assessing genuine financial health.
It really is.
I want to start with what I found to be the most fascinating and honestly the most counterintuitive truth that our sources reveal right from the get-go. Because this really is the core of our entire deep dive.
Okay.
We're all taught, in school, in business class, that profit is the measure of success. But the central conflict we need to resolve today is this. How can a profitable company still fail?
And that paradox, that's exactly why this topic is so critical. Profit, as you see it reported on an income statement, it relies on something called accrual accounting.
Okay, let's unpack that a little. Accrual accounting.
It just means that revenue is logged the moment a sale is made, and expenses are logged the moment they're incurred. It doesn't matter when the physical money actually changes hands.
So you could have sold, say, $1 billion worth of goods. On paper, you look hugely profitable.
Exactly. Hugely profitable. But if you gave all your customers, say, 120 days to pay you, and at the same time your own suppliers are demanding payment in 30 days, you see the problem. You run out of physical cash.
So profit tells you about the value of the transactions you've made, but cash flow, that tells you about your survival.
That's a great way to put it. It's the difference between having a fantastic retirement plan for 30 years from now and having enough money for groceries to get you through this week.
You need both, but one is a bit more urgent.
Precisely. Cash flow is the ultimate barometer of liquidity, and liquidity is life for a business. That shortage of immediate available cash, that's the cash flow crisis, and that's what drives companies into bankruptcy, even while their accountants are printing out statements showing millions in net income.
So today, we're here to understand the anatomy of that cash movement and why it, not profit, ultimately dictates value.
Yeah, that's the mission.
Okay, let's unpack this with a little more technical rigor. When we talk about cash flow, or CF, especially in forecasting, we're not just talking about a vague movement of money. This is a highly specific, defined payment.
That's right. When analysts are modeling future payments, especially in really complex financial products like derivatives or, say, long-term infrastructure projects, that payment has to be defined by 4 non-negotiable variables.
And the precision is paramount, right?
Oh, absolutely. The value of that payment changes based on every single one of these factors. It's not just a number.
So our sources lay these 4 variables out very clearly. The first is time, what is written as a lowercase t. And this isn't just the year. This is the precise moment the cash is expected to hit the account.
The second is the nominal amount, or N. This is just the raw number, the face value of the payment, the $1,000, the $1 million, before we adjust it for anything else.
Third, and this is a big one, is currency, or CCY. Is it in US dollars, or is it in a more volatile emerging market currency? That immediately changes the risk profile.
It changes everything. And finally, number 4 is the account, A. This specifies where the cash is coming from or going to. Is it an operational account? A subsidiary in a high-risk country? These 4 variables define the cash flow with enough certainty that you can build these complex, reliable models around it.
Without that level of definition, any financial analysis you try to do is just.
It's guesswork, pure guesswork.
And once we have that precisely defined CF, the sources immediately link it to 3 absolutely massive foundational concepts in finance: value, interest rate, and liquidity. They're all tied together.
Inextricably. They form a sort of triangle of reality for finance. We use the prevailing interest rate environment to figure out the present value of that future cash flow, which in turn determines our necessary immediate liquidity.
Which brings us to a process that is absolutely essential for transforming future money into today's money. We have to talk about discounting.
Yes. Discounting, the key to all valuation.
That sounds like something you get at a department store, but here it's a fundamental financial operation. It's the systematic conversion of a cash flow you expect to get sometime in the future, say at time t sub n, into a comparable amount of value today at time t0.
Right, we have to adjust. We have to ask the question, what is that future dollar worth to me right here, in my hand, right now? And this entire adjustment is driven by one of the most important principles in all of finance, the time value of money.
A dollar today is worth more than a dollar tomorrow.
It is always worth more than a dollar promised tomorrow.
Mhm.
And to make that mathematically true, we have to factor in two very specific concepts.
Okay, let's break those two down because they're really the engine of all valuation. The first one is risk.
Right. If I promise you $100, but I'm only going to give it to you 5 years from now, there's a risk, right? I might not be around. My company could go bust. Some economic disaster could happen.
Risk of default.
Exactly. So the riskier the investment, the higher the rate you use to discount that future cash flow, which means its value today drops faster and faster. Discounting is effectively a mathematical penalty for waiting and for uncertainty.
And the second concept is opportunity cost.
This is the big one. If I have $100 today, I can do things with it. I can immediately put it into a savings account. I can invest it in the stock market. I could use it to pay down some high-interest debt. By the time 5 years roll around, that $100 should have grown into something more.
So when you discount a future payment, you're essentially calculating how much you need to be compensated for giving up that opportunity.
Precisely. The prevailing interest rate environment, or maybe the required rate of return for a specific project, it quantifies that opportunity cost. If we didn't discount, a project that pays out $1 million next year would look exactly the same on paper as a project that pays $1 million in 50 years.
Which is obviously absurd.
It's a fundamental economic distortion. The faster the money comes in, the more valuable the project is, period.
So discounting is what separates really sound financial decision-making from just simple addition. It moves money through time so we can assess its true comparative worth.
And that leads us directly into the strategic applications. So now we know what cash flow is and why we have to adjust it for time. The next logical question is, why do major corporations and investors spend millions, literally millions of dollars, meticulously forecasting these movements?
Here's where it gets really interesting. This analysis, it's not just some academic exercise. It's the direct input for determining the viability and the value of multi-billion-dollar projects.
That's it. These cash flows, and just as importantly, their precise timing, are the essential ingredients for the most crucial financial models out there. Our sources specifically point to two of them: internal rate of return, or IRR, and net present value, or NPV.
The giants of capital budget.
For giants, yes.
So let's elaborate on NPV first. Net present value.
So NPV is the sum of all your future discounted cash flows. So all your inflows converted to today's value, minus your initial investment cost.
And if the NPV is positive?
If it's positive, the project is expected to generate value above and beyond the cost of capital, which makes it a good investment. But what really matters here is the sensitivity.
Sensitivity to timing.
Exactly. Because cash flows are discounted, the farther out in the future a cash flow happens, the smaller its present value contribution is. A delay of just 1 year in a major project's payoff can dramatically shrink the NPV. Sometimes it can even turn a positive project into a negative one.
Wow. So that really shows the enormous premium that business places on speed. Getting a cash flow earlier means it's discounted less heavily, which means it contributes significantly more to the project's immediate value.
Then you have the other one, IRR, the internal rate of return. This is the calculated annualized rate of return the project is expected to give you. Conceptually, it's the specific discount rate that would make the project's net present value equal to exactly 0.
And again, I'm guessing the accuracy of your cash flow forecast is everything.
It's paramount. If you promise an investor, say, a 15% IRR, but your operational cash flows come in slower than you expected, the true IRR plummets. It could potentially sink the entire premise of the investment.
So faulty cash flow inputs create faulty valuations.
They do. These models show that cash flow is the engine. IRR and NPV are just the gauges on the dashboard, and if the engine is miscalibrated, the gauges are just going to lie to you.
But maybe the most vital strategic use, the one that prevents companies from failing, is what you could call the liquidity litmus test. Let's circle back to that paradox we started with.
Yes. Being profitable does not necessarily mean being liquid.
It's the difference between theory and reality.
It really is. Accrual profits are the theory. Liquidity is the reality. And a critical function of cash flow analysis is preventing that catastrophic failure that's caused by a lack of working capital. Think about a fast-growing tech company.
Okay.
They're signing massive contracts, which generates massive accrual profit on their income statement. But at the same time, they have to spend heavily right now on R&D, on salaries, on inventory. If those big contract payments don't actually arrive for 90 or 120 days,
They have a massive short-term deficit,
mm,
and the bank doesn't care about your future profits when the payroll deadline hits today.
correct. The cash flow statement is the only one of the main financial documents that truly maps this immediate present-day solvency. It shows whether the company can meet its short-term bills, like accounts payable or salaries, using the cash it generates from its operations,
Or whether it has to resort to emergency borrowing.
which is often a death spiral.
And this leads us right into the strategic role of cash flow in challenging traditional accrual accounting, which, it often gets criticized for failing to represent true economic reality, at least in the short term.
Absolutely. The sources talk about scenarios where traditional profitability is, well, it's either artificially inflated or it's just plain irrelevant. Consider a company that does a lot of barter trading.
So they trade their product for something else, not for cash.
Exactly. They exchange their product for, say, manufacturing services or raw materials from another company. They log this transaction as revenue and an expense, and their income statement looks perfectly healthy. They are notionally profitable.
But wait, they have no actual cash coming in the door. They have inventory and services, but no liquidity. So how do they pay the electric bill? How do they pay their salaried employees?
That is the disconnect. That is the exact problem the cash flow statement highlights. If their operational cash flow, their OCF, is near zero or even worse, negative, despite all those paper profits, the business model is fundamentally unsound for a monetary economy.
The cash flow statement forces an investor or a manager to ask the hard question: how is this company actually surviving?
And the sources provide the damning answer. If OCF is minimal, the company has to be getting additional operating cash from somewhere. And that somewhere is usually issuing new equity shares or raising more debt.
And that's the telltale sign of a struggling business that's just masked by high accrual profits.
It is. The cash flow statement reveals that the company is basically feeding itself by continually tapping the capital markets, selling off pieces of the company, or taking on more debt just to cover its day-to-day operational costs. This isn't sustainable growth, it's operational life support.
So cash flow analysis is really an evaluation of a company's income quality. If your net income is high, but you constantly have to issue debt just to keep the lights on, that income is what you'd call low quality.
Precisely. Low-quality income is often made up of large non-cash items. Aside from our barter example, you could think of large write-downs or write-ups of asset values, or massive increases in accounts receivable.
Which just means your customers owe you a lot of money they haven't paid yet.
Right. If your profit is all tied up in a growing mountain of inventory or a pile of IOUs, it is not liquid cash. High-quality income is income that translates directly, consistently, and reliably into cash flow from operations.
That is such an essential message for any analyst to remember. Always trace the profit back to the cash. If that connection is broken, the profit figure is, at best, misleading.
And finally, we should just briefly touch on the specialized use of cash flow in high finance, particularly in structured products and risk mitigation. For big institutional investors, like pension funds who are engaged in something called liability-driven investment, or LDI, cash flow forecasting is everything.
Like LDI, right? That's where you have very specific future obligations. Like for a pension fund, they have to make payouts to retirees that are certain in their timing and amount.
That's right. For a pension fund, the main goal isn't maximum profit. The goal is to precisely match the cash inflows from their portfolio, from bonds, annuities, and so on, to their future cash payment requirements, the pension payouts.
So it's a giant matching game.
A very high-stakes matching game. Cash flow analysis allows them to model the default risk of every single asset in their portfolio and structure their investments so that when a big payment is due in, say, 2045, they know with a very high degree of certainty that a matching cash inflow will occur in 2045. It's all based on the precision of forecasted cash flows.
Okay, so that moves us from the why, the philosophical justification for cash flow, to the how, the practical structure. If we're tracking this vital movement of money, how is it categorized for financial reporting? It can't just be one big bucket of money sloshing around.
No, absolutely not. And this structured presentation is critical to understanding the company's story. Financial standards dictate that cash flow has to be broken down into 3 distinct types of activities. These are the 3 pillars of the cash flow statement, and each pillar answers a different question about where the money came from or where it went.
Let's start with the most important one, the foundation. Pillar 1, cash flow from operating activities, or OCF.
OCF is the engine room of the business. It covers all the cash generated by the company's regular day-to-day business operations. We're looking at transactions related to selling the core product or service that the company exists to sell.
And the significance of OCF is that it tells us if the primary activity of the company, the whole reason it was founded, is financially viable on a cash basis. Can this business actually sustain itself?
Exactly. The components are pretty straightforward. It's cash receipts from customers for sales of goods or services, and then cash payments made for all the operational necessities. So payments to suppliers for raw materials, payments to employees for wages, payments for rent or utilities.
And if OCF is chronically negative?
If it's chronically negative, the company is burning cash at its very core. It is an unsustainable model, full stop.
Okay, moving on to Pillar 2, cash flow from investing activities. This section tells us where the management is putting its money for the long haul.
Yes. Investing activities cover cash flows that are related to acquiring and disposing of long-term assets. This section reveals the company's capital strategy. When you see cash outflows here, it often represents a strategic decision to buy assets that will contribute to revenue years down the line.
So this would include things like purchasing a new manufacturing plant, upgrading machinery, buying a fleet of delivery vehicles.
Or even making investments in the stocks or bonds of other companies.
And the reverse, cash inflows here, would be selling off old equipment or maybe divesting a non-core part of the business.
Exactly. And crucially, the outflows in this section are what we define as capital expenditures, or CapEx. And that's the necessary fuel for future growth and for maintaining a competitive advantage. A company that consistently shows zero investment cash flow is a company that is coasting toward irrelevance.
Which brings us to our third and final pillar, cash flow from financing activities. This is the section that reveals how the business funds its own existence, particularly through debt and equity.
Right. Financing activities detail the net cash flows that are involved with the company's owners and its creditors. It's all about the money related to the capital structure of the firm.
So what are the key components here? We're talking about borrowing money, which is a cash inflow.
Right. And then repaying the principal on those loans, which is a cash outflow. Or issuing new shares of stock to the public, another cash inflow.
And the outflows here would also include paying dividends to shareholders and repurchasing the company's own stock.
Correct. And this section is often the place where a struggling company, the one with poor OCF we talked about earlier, shows large inflows. They're constantly financing their operations by taking on more debt or diluting their existing shareholders.
And on the flip side, a very successful mature company might show large outflows here, from paying massive dividends or engaging in big stock buybacks.
It's a very telling section. And once we take the sum of all three OCF, investing, and financing flows, we get the total net cash flow. That number simply equals the change in the company's bank balance over that reporting period. But as we've already hinted, we cannot stop at that single number.
Right. That's the trap.
It is. We have to drill down into the mechanics, especially for OCF, because it's the most complex one to calculate. It requires moving back from accrual net income to the actual movement of cash.
Okay, let's get into the calculation specifics then. The sources give us two common paths for calculating OCF, and both are necessary because they reveal different aspects of the operating engine.
So the first detailed OCF formula is what's called the indirect method. You start from the bottom line of the income statement. So OCF equals net income plus depreciation and amortization plus or minus the changes in working capital.
It's basically a reconciliation process.
It is. You're just reconciling net income back to cash. The second method, the direct method, is often preferred by analysts because it's cleaner and it isolates the impact of taxes. That formula is OCF equals EBIT, that's earnings before interest and taxes, multiplied by 1 minus the tax rate, and then you add back depreciation.
The goal of both methods is to strip out all the non-cash entries that distort the picture of liquidity.
That's the whole point. And of all those adjustment items, the change in net working capital, or NWC, is one of the most operationally revealing.
Remind us of the definition. NWC is current assets minus current liabilities.
Correct. And this number reflects the company's investment in its short-term operating cycle.
Okay, so let's make that operational. If NWC increases, what does that tell you about the company's cash?
An increase in NWC means the company is tying up cash to fund its current assets. Think about what's in current assets: inventory and accounts receivable.
Money owed to you by customers.
Right. So if your inventory levels shoot up, you had to spend cash to buy all those goods. If your accounts receivable increases, it means your customers are taking longer to pay you, which locks up your sales revenue in IOUs instead of cash. Both of those situations reduce your OCF. It's a cash outflow.
And conversely, if NWC decreases, it's a cash inflow. The company's freeing up cash.
Exactly. Maybe they successfully reduced their inventory levels without hurting sales, or, and this is a critical one, they started delaying payments to their own suppliers, which increases their accounts payable.
That's a short-term cash injection, often called stretching your payables.
It is, and these dynamics are so important. A company can dramatically improve its OCF temporarily just by aggressively managing its NWC, collecting from customers faster or paying suppliers slower. But that strategy might strain your supplier relationships down the road. The NWC adjustment is a window into those short-term operational management decisions.
Now, for the one that is the most counterintuitive, but also highly profitable to understand, depreciation and amortization. Why are these expenses, which seemingly reduce profit, actually added back to increase cash flow?
This is such a crucial financial mechanism. It's known as the depreciation tax shield. Let's start by just reiterating that depreciation is a non-cash expense. You bought the machine 5 years ago. Today's depreciation entry on your books is merely an accounting procedure allocating that cost over time.
Right. No physical cash leaves your bank account when you record depreciation. You're not writing a check for it.
Exactly. But, and this is the beautiful part, the IRS sees it as a legitimate expense.
Okay. That's the key.
That is the key. Because the depreciation amount is listed as an expense on the income statement, it lowers the company's net income before taxes. A lower taxable income base means the company owes less in corporate tax.
And taxes are a very real, very large cash outflow.
They are. So reducing the tax bill directly translates into more cash remaining in the company's bank account.
So let me get this straight. The company didn't actually pay, say, $100,000 for depreciation this year. But because they recorded that $100,000 expense, their taxable income dropped, and they might have saved, say, $30,000 in actual cash taxes that they didn't have to send to the government.
That is it, precisely. You add the full depreciation amount back because it wasn't a cash outlay in the first place, but the real cash benefit comes from the tax saving it enabled. The depreciation tax shield is a genuine, non-operational source of cash savings. It's why it must be factored in when you're assessing liquidity. It's a critical nuance that really separates amateurs from seasoned analysts.
And speaking of cash going out the door, let's just finalize our components by clearly defining capital expenditures, or CapEx, again, since this outflow is the main component of that investing section.
Right. CapEx is the investment needed to either maintain or expand the operating capability of the business. These are substantial expenditures that create future economic benefits that last longer than just 1 year.
And we can distinguish between maintenance CapEx.
Yeah, that's the money you spend just to keep the current assets running to repair things. And then there's growth CapEx, which is money spent to expand capacity, build new facilities, or develop new product lines.
And a healthy company must, at a bare minimum, cover its maintenance CapEx from its OCF, its operating cash flow.
It has to. And a growing company must be spending significantly on growth CapEx, which will inevitably show up as a substantial negative number in that investing activities section of the statement.
So if a company reports really high OCF, but it has zero CapEx, that's a huge warning sign.
A massive warning sign. They're effectively harvesting their assets. They're extracting the maximum cash today while completely neglecting their future operational needs. It's a short-term game.
Okay, now we have all the pieces. We understand the definition, the strategic use, the 3 pillars, and the critical adjustments like the tax shield. It's time to move to the main event, showing why looking at that net number, that single bottom line number, is a trap.
This is the moment. This is where we prove the total inadequacy of the single total number. And the source material provides a brilliant comparative case study, Company A versus Company B, that perfectly illustrates how to properly read the cash flow statement.
Let's review their performance over 3 years. And remember, as you listen, we're looking at the composition of the cash flow, not just the final total.
Okay. In year 1, Company A generated cash flow from operations OCF of a very robust plus $20 million.
Okay, $20 million.
Company B, in that same year, generated OCF of only plus $10 million. Both companies then received plus $5 million in financing cash flow. Maybe they took out a small annual loan or issued some new shares.
But here's the key divergence, and it's found in the investing section. Company A spent minus $15 million on capital expenditures. They bought new equipment. They expanded their capacity.
Right. Company B, however, invested $0 million. They bought nothing.
So when we add up those three pillars, the results are, well, they're startlingly different from what you might intuitively expect.
They are. Company A's net cash flow is plus 20, plus 5, minus 15, which results in a total of plus 10 million.
Okay, plus 10.
Company B's net cash flow is plus 10, plus 5, plus 0, which results in a total of plus 15 million. And this pattern continues across years 2 and 3, which means Company B is adding more cash to its bank account every single year.
So if I was a superficial investor and I was just comparing their bank balances, I would conclude that Company B is the superior business.
Right.
They're accumulating cash faster.
You would, and you would be completely wrong. This is the financial trap we've been talking about. The deeper analysis reveals that Company A is fundamentally healthier and is building far more long-term value than Company B.
Let's break that analysis down into the two critical insights. First, core health.
Look at the OCF. Company A generates twice as much sustainable cash from its core business operations, 20 million versus 10 million. Company B is generating minimal operating cash flow and is relying far more heavily on that 5 million in financing, that external funding, just to reach its total net positive flow.
So Company A's engine is just much, much stronger.
It's twice as strong, and that strong OCF in Company A, it signals high-quality income and real efficiency in their day-to-day operations. They are not dependent on the whims of bankers or stock issuance just to keep running.
And the second insight is future growth.
This is the big one. Company A is committing $15 million every single year to CapEx. This is a massive strategic investment in their future productive capacity. It means they're upgrading their technology, they're preparing for expansion, and they're maintaining their competitive edge. Their lower net cash flow today is a deliberate choice for growth tomorrow.
Meanwhile, Company B, with their higher net cash flow today, they are investing nothing. Zero CapEx.
Nothing, which means their current machinery is aging, their facilities are deteriorating, and they are not expanding to meet market demand. They are actively sacrificing their future potential just to make their bank account look a little better today.
In short, Company B is a decaying business model.
It is. They're effectively liquidating their assets slowly. Their slightly higher net cash flow is a short-term illusion of safety. Company A, despite having that lower net number, has a robust, highly efficient operating engine that is funding its own future growth. Any seasoned analyst would overwhelmingly prefer Company A.
That is such a powerful demonstration of why the composition of the cash flow matters infinitely more than the total. You have to know where the cash is coming from. Is it sustainable operations or is it external financing? And you have to know where it's going. Is it strategic investment or is it just covering current deficiencies?
In this discipline, it extends even to the realm of public finance. Our sources emphasize that governments, just like corporations, have to rely on effective cash flow planning for fiscal control.
Right. Governments need to meticulously forecast the timing of large tax receipts versus massive spending obligations like debt servicing or big infrastructure payments to make sure they avoid a liquidity crisis.
It's the exact same principle, just on a massive scale. Managing the timing of inflows, like taxes and bond sales, versus outflows like public salaries and defense spending, to avoid insolvency, even if your overall budget is balanced on an annual basis.
This has been a really comprehensive look at the world of cash flow, moving from the philosophical necessity all the way to practical application.
It's been a good deep dive.
Let's quickly recap the 4 most valuable nuggets we've uncovered for everyone today.
Okay. First, the fundamental distinction. Profit is a measure of transaction value using accrual accounting. Cash flow is the measure of immediate liquidity and survival.
Yeah.
You can be profitable and still fail.
Second, the transformative role of discounting. The time value of money, accounting for risk and for opportunity cost, means a future dollar is never worth the same as a dollar today. And discounting is what makes valuation possible.
Third, the non-negotiable structure. You must examine the 3 pillars, operating, investing, and financing separately, because the composition of the cash flow is the true indicator of financial health and strategy, as we saw in our Company A versus Company B case study.
And fourth, the hidden profitability of accounting rules. The depreciation tax shield. Because depreciation reduces your taxable income, it results in real, tangible cash savings that have to be added back into the cash flow calculation.
And all of this complex analysis, however, depends entirely on one single thing, cash flow forecasting. It's the act of predicting these movements months or even years into the future.
Which leaves us with a final provocative question for you to consider as you process all this information.
Yeah, think about this.
If cash flow, especially for a very long-term project, is inherently uncertain and it's reliant on all these complex external factors, market demand, interest rates, competition, how much does the perceived quality and the perceived accuracy of the forecast itself influence a company's market valuation and its risk profile, especially when they're planning those multi-year, multi-billion-dollar capital investments?
The forecast is the story the company tells the market. And the better they tell that story, the more capital they are likely to attract, proving that in finance, perception that's rooted in precision often becomes reality.
Something to mull on until next time. Thank you for joining us for this deep dive.